But I think we're going to be cautious about declaring victory and sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time.
That was Federal Reserve Chairman Jay Powell yesterday after announcing a increase in interest rates of 25 basis points. That is the smallest rate hike since last March. Joining me right now is the former president and CEO of the Kansas City Federal Reserve. He is the former FDIC vice chairman and Mercatus Center distinguished senior fellow, Thomas Hoenig. Thomas, it's good to see you. Thanks very much for being here. Do you believe we are in disinflation? I mean, I'm looking at some of these numbers, like a dozen eggs up 60% year over year. I recognize we're off of the highs, but give us your assessment of Jay Powell's speech and the rate hike that we saw yesterday.
Well, I think, first of all, the economy is slowing. That was the purpose of raising the rates, so we're getting that done. And I think what you have is talking past one another a little bit. The market is saying the Fed has done so, inflation's coming down, and now they're going to begin to think about lowering rates again before the end of the year. The Fed is saying, no, we're just getting started, and we want to make sure you understand that we're just getting started, and so we're going to keep rates up. And the discussions inside the Fed will be, how long do we keep rates elevated? The market has led the Fed for over a decade and a half. That's why you have the market kind of pushing them to ease more quickly than they might otherwise, and the Fed has a credibility problem. So they're going to have to stick to their guns for a good part of this year. And I think we're going to have this difference going on through most of this year.
Yeah, but Thomas, somebody had to be messaging this potential pivot. I mean, it doesn't matter what Jay Powell said yesterday. Markets rallied. The NASDAQ finishing up better than 200 points. Now, this morning we heard the European Central Bank raised rates by 50 basis points. We had the Bank of England raise rates this morning by 50 basis points. So we're seeing this across the board in terms of global central banks. BOE officials also said that they see a, quote, much shallower recession than feared. So, Thomas, have things changed, in your view, in terms of the macro story?
I don't think things have changed all that much. We still have inflation. It's still well above, if you look at the CPI, it's still in the 6% range. Even the PCE is up. So I think we still have inflation. I think part of the problem is yesterday when the Fed raised only a quarter point, it kind of confirmed what the market has already been thinking. Well, they were getting close. We're going to do this. And so the Fed has slowed down even more. And that signal is, I think, hurting the Fed's credibility. But we'll see. They're still talking tough, but words are not enough. And the market has to be convinced the Fed's now in charge again, which it hasn't been for some time. And I think that's going to be a major factor going forward, whether or not they can believe the Fed. The leadership of the Fed.
Such an important point, the credibility, Mark.
Thomas, the market's pricing in a pivot without a doubt. Despite what Jay Powell continues to say, the market is pricing in a pivot. And Neil Kashkari recently said something along the lines of investors are playing a game of chicken with the Fed and they're going to lose. What do you make of that?
Well, I think that's words again. I mean, Kashkari is now kind of a hawk, and he's trying to convince the world that they're going to be tough so that the market believes them. But look at their actions over the last decade and a half. That's what they're looking at, and the market's always been right over the last decade and a half. The Fed has always stepped in, always taken care of things, always lowered rates, always did QE when they needed to. So that's the track record. So the Fed has to disprove that track record, and that is their actions are going to have to speak a little louder than their words.
Go ahead.
But Thomas, do you think, the Chairman Powell has said always that he's going to be looking very carefully at what really is going on. So it's hard to predict what the future is going to bring. But do you think that when you're looking at things and you're seeing the trailing events are predicting a drop, if not what you are talking about in inflation, the Fed's going to calm down?
Well, I think the Fed will come down, but inflation is still too high. And we keep talking about the fact that it moved from 9% to 6% is something, that's so significant, they think, but that's so far away from 2%.
Yeah.
So the Fed has to be tough, and they have to hold their ground, but that's not their track record. So they have to change how they're perceived by the market. And right now, the market's perceiving that if they get down, if they continue this decline, we see good numbers for January and then perhaps for February. I think there's going to be even more pressure from the market saying, you know, the Fed's going to ease, you've got to ease, and the expectation is being pushed towards the Fed that, yes, you better deliver for us. And I think that's where Powell and the FOMC as a whole that's what will define their legacy.
Yeah.
The next 2 months will define their legacy,
Thomas,
I think.
I've got to get two items on the agenda in front of you to get your reaction. Number one, House Speaker Kevin McCarthy says he sees an opportunity to come to an agreement on the debt ceiling. So we're going up against this June deadline. He says he has he had a very good meeting with the president yesterday. He reiterated the stance that there's no threat of a default, but that there is a massive threat with this overspending. And number two, this unwind of the Fed's balance sheet. We've talked about this a number of times. The Fed going to take $1 trillion out of liquidity because they are unwinding that balance sheet. Doesn't that create a market disruption this year? Your thoughts?
Well, first of all, on the debt ceiling, I think, you know, they have to get the spending under control. We have to get back to some kind of an agreement. You can't go from $4.5 trillion spending before the pandemic to over $6 trillion consistently, with the debt going from $10 trillion to $30 trillion. So McCarthy's right. You're going to have to get an agreement to get spending under control, and I think they will do that. They have to do that because you can't default on the debt. So that, I think, will take place, but it's going to be very painful and very bitter. So I think that's, you know,
and the
number
unwind?
one.
The unwind?
The unwind is going to continue. That, you're right. That's going to put pressure. Now, remember, there is so much liquidity. I mean, they moved the balance sheet up from less than $4 trillion to $9 trillion. So there's so much liquidity out there still going that they have to take some of it even out now to keep the rates up. So that is an unwind that's going to have to continue, and it will be disruptive at some point.
Yeah.
And I'd say towards the end of this year, because they're still early in the process. They're not, you know, they're well below $1 trillion out. So they've got to get much further, and they better stick to their guns there too. But it will be disruptive once they get to that point, and we'll see if they can stick to their guns.
We got to jump real quick, Liz.
Real quickly, did Jay Powell make a mistake yesterday? If he had raised rates by 50 basis points, would the market have paid attention to his message?
It's a great question.
Yes, they would have. It would have been a very significant signal. We mean what we say.
Yeah.
Had they done that, and what he did instead was confirm the 25 basis point. I understand why he may have done it, but the 50 basis point would have said to the world, we're serious.
Yeah.
Thomas, we love having you. Thanks very much for being here this morning.
Thank you.
Love your expertise.
My pleasure.
Thomas Hoenig.